Thank you. Thanks very much. Is it the title of my presentation or what? Half the people are not showing up. Maybe you did want to hear about economics. No, I doubt it. Of course you do. Of course, maybe real economics would be good, but what is currently understood today to be economics is basically failing, right? And that's what makes gold so interesting. I'm just back from speaking in a number of countries, but I'm on this subject, not this presentation, a different one, but not to the converted. I'm basically been invited to speak to fund managers and financial advisors in a few countries, India, Jordan, Netherlands, and I always ask the question at some stage during my presentation, how many in the room actually own gold, or have you got gold as part of your portfolio's investments for your clients? And there's never any hands that go up. And Egon this morning posed a question, and it reminded me that this particular group is quite unique in the sense that you probably virtually all own gold. So one question I would like to ask is, how many of you actually own more ounces this year than you did last year? Please raise your hand. Good Lord. Definitely preaching to the converted today. This is the obligatory disclaimer. I'm a financial advisor, so anything you hear from me here this afternoon is not advice. If you take it as advice, it's your problem. That's what that means in Morgan. And I think I finished last year with this slide because that's how a lot of my colleagues in the industry perceive me, as a doomster. You know, the guy who's going, the end is coming. Well, it's interesting. Even in Montreal a couple of weeks ago, I was interviewed, and the interviewer said, "What are you afraid of?" Because I'm talking about gold, I'm talking about debt being unpayable and so forth. I said, I'm not afraid of anything. It's not the end of the world that I'm forecasting, it's just the end of the monetary system. Get over it, it's happened many times before. So all this is about money. That's all it's all about. That's why gold is so important. It's at the core of this whole subject. And even going back to Aristotle's time, people knew that fiat money eventually fails, the reason being human nature. Give anyone a printing press, and they'll use it to the point of collapsing that paper. Today, all paper, all currencies are fiat. And I don't want to labor on the topic because you probably all know this. But believe me, investment professionals, my colleagues who manage money, who are advisors like me, don't. And that's scary. That's very scary. All the currency, everything that's in our pockets, even a $50 note is a note. It's credit. That's all it is. And J.P. Morgan himself in 1930 said that gold is money and nothing else. Everything else is credit. Famous words. That's not how money began. Money wasn't always part of human life. It just came to be from experience. People realized that they needed an intermediate good to have more exchange and more faster exchange. And it just so happens that the good that served that purpose the best turned out to be gold. So people decided that gold was money before money existed. Eventually, gold started being coined. That's when the state got interested in managing, I guess, or being involved with monetary matters. But it was really more an administrative role and a secondary role rather than, basically the kings deciding that gold was money. It was people who did. People who decided how much was in circulation as well. Compare that with today. Today was no choice in the matter. We have to take what is called legal tender in our respective countries. You can't even use Australian legal tender in the US or US legal tender in Australia. And don't ask me why, because that would just be competition. And last I heard, competition is a good thing in the economy, right? But not when it comes to money, for some reason. So we have had what I call fiat abuse for quite some time. Now I want to talk a little bit about a concept that is well known in scientific circles, which is measure. And in economics, as we know it today, most measures when it comes to money are aggregate measures or relative measures. Currency exchange rates, for example, are relative measures. There is no definition, there is no measure as such for any currency. You know, if I go back, can anyone tell me what is the definition of a dollar? There used to be a definition. At the moment, that's not even a dollar. It says $1 in the note, but it's a Federal Reserve note. We should stop using USD for the symbol for US dollars. We should use FRN. So, we are swamped with aggregate statistics about money, money supply, and so forth, but really, we don't really know what money is. Think of any other scientific endeavor. In science, the basic unit of measure of whatever it is that you're measuring is pretty precise. And not only is it precise, but it's fixed. It's agreed. You know, an inch is an inch, or a meter is a meter. A second is a second. A degree Celsius is a degree. It doesn't fluctuate. It's not floating, or it's not an elastic measure as the economists love. It's fixed. And so we know exactly what we're measuring. Not in economics, or today's economics. It's interesting, I didn't know this until recently, but when the pound, British pound, came onto the gold standard, a scientist was master of the mint, Isaac Newton. And one of the first things he said was, gentlemen, in order to measure, you must define your unit. You know, a dollar was defined under Bretton Woods as 1/35th of an ounce of gold. That was a definition. The Arabs knew that if they sold oil for so many dollars, it was equivalent to gold in so many ounces. That all changed after Nixon, of course, and that's why oil price went up. But since that day, we don't have a measure. Now, very briefly, gold became money a long time ago, but why is it still money is basically because there's a lot of it around. I know that sounds weird to say, but it's the most abundant commodity in existence relative to its annual additional supply. So although it is rare, it's hard to get out of the ground. Miners, don't attack me, I know it's hard. But when you look at how much already exists, and the numbers they float around is 170,000 tons, more or less. It's probably more than that, actually. But let's say 170,000 tons, there's another 2,000 tons that's produced every year. So it's not the annual increment that is a supply, it's the existing above ground. And that's what makes gold the commodity that can play the role of being a measure of value. And that's why there was a standard called the gold standard. It's not that gold is necessarily magical. It's got properties that makes it ideal to serve as a stable unit of measure. So it's all about measure. I see Outfield is sitting in the front row here. So one thing I wanted to point out is I completely agree with his analogy of last year. And I say that to the investment professionals. I say we've been in the desert for 40 years. You've all forgotten how, what money is. How many of you weren't here last year? Please raise your hand. Okay, well, Alf, this is not me, this is Alf Field. Brilliant analogy. Moses went into the desert with the chosen people, according to the Bible, and was taking them to the promised land, but stayed in the desert for 40 years. Why? God was so powerful, why didn't they go straight to the chosen land? Well, you need 2 generations for people to actually forget what life was before, what life was like before. So when they left Egypt, they were familiar with Egypt. They spent 2 generations in the desert. By the time they got to the promised land, probably the older generation died, and the newer generation arrived in Israel not knowing any better than the desert for all their lives. So when they arrived in Israel, it did look like the land of milk and honey, although it was exactly the same as in Egypt. I think whether that's an exact or correct replica of your analogy, I thought it was brilliant, because I went to university in the early 70s, Economics 101, which very nearly drove me crazy, was in 1973, at a time when, and it was a French university, you'd think they would have been teaching what Jacques Rueff, who was the financial advisor to de Gaulle, argued. He was the man behind, actually, France sending ships across the Atlantic and getting their gold before it was too late. No, we were all taught, how banking works, and not a word mentioned about the Nixon event in '71, and that was 40 plus years ago. It took a long time to wake up, but I'm wide awake now. Here's the truth, as I see it, about our system. Because gold isn't in the system anymore, at least officially, debt is really what drives the system. It's the basis of the system. Money is debt, and therefore government debt is the basis. Because government debt, or paper, is the largest asset owned by commercial banks, it's pretty important what the value of that sovereign debt becomes, or how it evolves over time. I think it has a lot to do with the LIBOR rigging, personally. It had more to do with maintaining high values on their balance sheets than anything else. But more importantly, and this is where it's mostly to the investment professionals I tell this, when they construct portfolios, investment portfolios, retirement savings or whatever, government debt is the lowest risk asset class in the portfolio. And generally it'll be their own domestic sovereign debt. But around the world, it's largely accepted that the U.S. sovereign debt, U.S. Treasuries, is the least risky investment you could make. For those reasons, government debt has a systemic role, much more than what it would normally have. Everybody owns it. We're all funding the bastards, So, it's very, very important for those who are in charge, and they know this, to maintain the value of that debt. So that's what the engineering is all about. Here's a slide that I use in those presentations to fund managers, and it strikes me as really odd that even these are all facts on this slide about the U.S. debt. And why do I focus on the U.S. debt? Because, well, it still is, as far as I know, the situation that the U.S. dollar is the global reserve currency, so let's have a look at how well they do at paying their debt. Well, they haven't paid a dollar back since 1961. They just roll the debt and add. The debt's always going up. That's 50 years. It took 200 years to add the first trillion, and now Mr. Obama does it virtually in his sleep. It's over 16 trillion. I mean, we talk about trillions, right? It's like we don't really care anymore. Best analogy I heard about a trillion is that if you were born the day Jesus Christ was born, and you had the ability to still be alive today, and had also spend $1 million a day, every day of your life, every day you spend $1 million for 2,000 years, you still wouldn't have spent $1 trillion. It still doesn't come up to $1 trillion. So $1 trillion is a lot of money. But because U.S. Treasuries are considered the least risky asset in investment portfolios, and that's what all the institutions do when they manage other people's money, it's important to look at the record of how they pay that debt. Because they don't pay their debt, every new kid that comes along that's cursed with being a U.S. citizen has their bill. When I started talking about this subject in 2009, that was a contemporary picture, so that was the actual amount per capita, 38,000 or so. Now it's over 51,000. By the way, that's more per capita than Greek people or Spanish people. I mean, U.S. is in a much worse situation than any other country, really, when it comes to debt. So, I call the central bankers delusionists because they keep us in a delusion. Others have used, Egon's used the word delusion this morning. But you think about this, our currency, what we have in our pocket and what we measure our assets, liabilities, our wealth, all this economic stuff is measured in, say, dollars. But we don't know what a dollar is. But we have faith in the central system. It is a central system, by the way, central banks. We have faith because, we believe that they'll pay their debt. They'll honor their debt. Well, we've seen the track record. The challenge today is for them to service the debt. All the hoopla earlier this year about Greece defaulting, because it was a default, was about servicing the debt, not paying it back. Nobody's paying the debt back. Forget that. It's unpayable. It's beyond payable. Mathematically impossible. The growth rate you'd need is too high. But another belief that they desperately want to maintain is that they will preserve the purchasing power of that currency. You can continue having faith in the currency. And this is the real game. This is the real game. They must maintain confidence at all costs. Now, how do they do that? It's very simple. They perpetuate ignorance. I was absolutely stunned. I was in India, and I thought, in India, of all places where I talk about gold, they'll get it, right? Because India is the bid for the gold price, for gold. It has been for centuries. Maybe the man and the woman on the street understands what gold is, but the investment professionals there don't understand any more than anywhere else. What it's called is it's cognitive dissonance. If you're not familiar with that, look it up, Google it. Psychologists do a lot of research on it today. That's what drives us to ignore what's complicated. We'd rather watch who's going to be the next star on TV or something that keeps us brain dead, as opposed to really trying to understand and grapple with this very complicated, well, it's not really that complicated, but what is presented as being very complicated. And cognitive dissonance means that you end up deciding in your own mind that, well, I'd rather trust and have faith in the people who run the system because they are highly educated, they know what they're doing. And so that's what it's all about. And so we have financial repression. It's not the first time. In fact, I read a paper recently, which I give the source there, should you want to go and read it. But financial repression has been used before. Whenever the level of sovereign debt is very high and they need to take it down, they artificially repress interest rates. And there's other tricks too, which haven't really emerged yet in this phase of financial repression that's already started, but there'll be involuntary funding and capital controls. They use those after the Second World War to reduce what was a very high level of sovereign debt around the world relative to GDP. And it worked. It's a sheep shearing instruction manual, if you look at that report. And the sheep is you. Maybe not in this room, because you all have gold and you're buying more. But it's basically the general population. And the population who don't seem to have any, what is the word I'm looking for, freedom over how their money is managed, because a lot of people don't. A lot of people have to rely on the professionals who manage their money. While all this is going on, the central banks are buying gold. There you go. And what else do you need to know? I mean, sure, the central banks are trying to manage prices and therefore move interest rates, and we know all of that. But really, you have to look at what they also do in the gold market. And they've been buying gold steadily and faster and faster. In fact, more than since the early 60s. And that doesn't even count what China's doing. China, I would guess, has already got at least 4,000 tons, not the 1,000 reported. It imports 400 tons from just Hong Kong in 6 months. So, what I say to my clients is, be your own central bank. It's pretty simple. It's good enough for the central banks, must be good enough for you. Problem, which is really the implementation. How do you go about buying real bullion? There's a number of approaches, offers, people in the business. Not all of it is real bullion. So you have to be very careful how you approach that. But what it's all about, what is it all about? It's about the central banks are buying bullion, or they're buying gold, not to be wealthier, but because they know gold is coming back in the system. They actually want gold to come back in the system. That's my view. Got a few slides later to suggest. I think David suggested something to that effect, David Evans earlier. We use a similar chart from Nick Laird, the Sharelinks, great charts. But why do I say to clients, buy some gold? I don't mean put all your money in gold by any means. I'm a private wealth advisor, so most of the money is still invested. But it's about 20 to 30% in bullion, which is not an investment. It's just saving. It's just money that's, the investment of that money is deferred until later. That's how I put it. No, but it's all about purchasing power. The central banks know that the purchasing power of their currencies is eroding. In fact, what they do erodes the purchasing power of their currency. So they know that ultimately that confidence that the system relies on will also erode. So by then, hopefully they'll be ready and they'll have the amount of gold that they need to go back onto some kind of gold-backed monetary system. That's what I expect. So it's about purchasing power. Warren Buffett's got that right when he says, investing is really about giving your money to someone else, or, someone else doesn't necessarily mean an investment manager. It could be a company. You buy the stocks, or you lend your money to another company. So you give your money away in the hope of getting more later on, therefore increase your purchasing power by investing. What he pretends not to know or to ignore, but I'm sure he does know it. He just wants you to stay in the markets. That's what he wants. Preaches for his own place. Is that, after 40 years of fiat abuse, you don't need to invest your money to increase your purchasing power. You just need to hoard gold, not very hard. And it's going to continue. Why do I think it's going to continue? Because we're told that we're going to have negative real interest rates for quite some time to come. And historically, if you do the research, whenever real interest rates, that's interest rates after net of inflation, are below zero, Gold does well. Gold does well. People are not stupid, you know. If I'm not going to be rewarded for investing, I'm just going to save instead. And in the most primitive form of saving, I'm just going to hoard gold. And now all the banks are doing it. So should you, well, you're all doing it, so that's great. Just a word on the bubble. It does look like a bubble, doesn't it, when you put it that way, when you just look at nominal prices and you look at the non-logarithmic scale. Of course, an increase from $10 to $100 is tenfold increase. But an increase from $100 to $200 is just 100% increase. And that's not shown on this chart. What you need to do is transfer the information on the logarithmic scale. And sorry, this chart here is that right? That part there, since 2000, is that chart. Doesn't look the same, does it? I entitled this chart Price Governance Evidence. I defy you to find another market ever that for 10 plus years has appreciated at a constant rate. That's what that is, with 95% confidence interval. I think that means that they want the gold price to keep going up. In fact, I'll go a bit further based on an experience I had in the Netherlands last month. Are you familiar with the case? Very little reported, but there was a pension fund in the Netherlands that 2 years ago, the trustees decided to allocate 13% of their assets to gold bullion. How many of you are familiar with this case? Yeah, it's not very well known, but a few hands went up. Well, the regulator there is the central bank, and they said, gold is too risky. You need to have no more than 3%. Huh? Went to court, the judge rubber stamped the Reserve Bank, and they had to sell down from 13 to 3%. What is even less known is that the trustees took the central bank to the appeals court, and they won. Because they asked the Reserve Bank to prove that gold bullion is risky. They couldn't. So the judge ruled in favor of the pension fund. And the pension fund, just long story short, they sued the central bank for the difference. Priceless stuff. But I kept asking myself the question since then, why 3%? Why would the central bank say, gold's too risky, 3%, no more? Where does that come from? Well, I think that, and this is me completely speculating here, it's because that's what central banks can live with. As for you having a private ownership of gold. Think about this, you know, in the whole financial assets, all pension funds, endowment funds, all the investments in the world, savings added up is a little over 200 trillion. Well, there's less than 1% of that's allocated to gold at the moment. If that was to go up to 3%, we'd be at Jim Rickard's price, where 40% coverage of money supply, right? And that's probably what they want. That's just a guess of mine, but 3% also did a bit of research, and if you go back to the 1960s, before Nixon default in 71, and you look at the typical asset allocation of a pension fund in North America, anyway, that's where I look, that's where I'm from. Live in New Zealand now, though. It was about that, 3%. Funnily enough. So you're ahead of your time, you know, because I fully expect that at one point in time, they'll pass a law or whatever it is. That's part of the compulsory funding or capital controls. They'll say to pension funds, you need to have 50% in government bonds, because we need someone to buy those bonds. and they'll say, well, you can have gold, but no more than 3%. But I'm not a pessimistic in the sense of expecting chaos or anything like that. Or even confiscation. I don't think they'll do anything about people who already own gold, because there's not enough of us. They're all in the same room. But they will control how much you can buy at some point in the future when they start seeing people buying more and more gold. There's not enough. Well, there's always enough gold. Sorry, I wouldn't rephrase that. It's just a question of price. So I'm going to speculate a little bit about the future, but very, very little, because it's a very risky business. And as Peter Drucker said, trying to predict the future is like trying to drive down a country road at night with no lights while looking out the back window. Actually, it sounds a lot like what actuaries do. And I'm an actuary, so I should know. But let's dabble a little bit in the future. Last year, I think, I'm not sure if it was here, but I said a few words about the prestige that I expect coming. Anyone, have you seen the film The Prestige? Raise your hands. Yeah, it's a great film. Great entertaining film. But in the film, I learned that the good magic trick has 3 phases. The pledge, the turn, and the prestige. The pledge is when the magician says, this is what I'm going to do. Okay? The turn is when they change the beautiful woman into a bird. No, into an animal of some sort. And the prestige would be to turn that beautiful animal in some sort back into the woman originally. And that's the hard part. That's the hard part. Well, think about money in the 20th century. What happened in the 20th century is, the Fed was created, and there was Bretton Woods and all this. And basically, they said, we're going to change gold into paper. And they did. And now the prestige would be to turn paper back into gold. Now, that would be quite a prestige, but I think that's the game plan. So, I've got a few possible scenarios here. I don't know if Mr. Ricard is in the room, but some of them are more pretty much aligned with, at the end of his book, he's got 4 scenarios. I think he mentioned those roughly this morning. Status quo is one of them. IMF, special drawing rights is one of them, and chaos at the bottom is also one of his. This is his most likely scenario, in his opinion. Not for me. I'm more optimistic than that. In fact, I would say that they go in descending order. We're going to have the status quo for quite some time. Status quo means financial repression. Don't kid you. It doesn't mean it's a nice, rosy, but we're going to see negative interest rates ongoing. We're going to see central banks doing whatever it takes. I love that expression. Whatever it takes. I give them the power, and they will do whatever it takes. The IMF is an interesting scenario. I mean, that's what we're going to be fed by the mainstream media over the next 3 to 6 months, I expect. It's already starting. With Lagarde. But would that be better? No, it wouldn't be better. Why would it be better? It's still fiat. And it's worse because it's only one entity, one currency. But I give a high probability of China doing something. China is pretty secretive about how much gold they're accumulating or how much silver they actually own. That's the big unknown. And they're not secretive about the fact that they want to internationalize their currency, and they've got a number of steps have already been taken, and a number have been announced. So they could, on their own, decide that one day their renminbi is redeemable at a certain exchange rate in gold or silver, quite independent from what the rest of the world does. That might create significant conflicts with the US. But another possibility is the Eurozone countries finally accepting to let go their sovereignty, and they have fiscal unity. Fiscal union is inevitable if you want monetary union, ultimately. And so they'll have to face the music and do it. And if they do, then as Jim Rickards pointed out this morning, they have enough gold to have the euro gold back. Or if the plan is really to go back on some redeemability with gold, the US could also do that. After all, they claim they have a lot of gold. Another possible scenario is that you'll have gold and silver coins circulating in competition with paper money as legal tender. I mean, in the US, there's a number of states that are proceeding with passing the legislation necessary for that to happen. In Mexico, there's the project of Hugo Salines Price of issuing the Libertad silver coin. So you could have that more and more. So, but all these scenarios have in common what's going to happen in the monetary system. That's what it's all about. It's money. It's all about money. So what can you do? Well, I guess I can't really teach you anything because you already buy gold. That's a conclusion. It's just buy and hoard gold. Not with all your money. Keep investing because, look, they're fully in charge of the price, okay? I don't think they can control the price to the sense of actually bringing it down to earlier levels. But they've got full control of the price. If they're happy to see it rise for a while, they'll let it rise. And if they don't want it to rise for a little while, they'll stay. Or they have to maintain that volatility and perception with the professionals that it's not a store, it's not a safe store. How can it be a safe store of value when its price fluctuates so much? This is the argument. Well, its price fluctuates because the bloody currencies are fluctuating. Never mind. So just continue what you're doing, basically. But what I tell fund managers and colleagues who are fellow investment advisors is educate yourself about money. You guys don't know what money is. And more importantly, I say they all have fiduciary responsibility as advisors. They must do what's in the best interest of their clients. And I tell them, you're not doing what's in the best interest for your clients if you're not at least taking into consideration that maybe we have a monetary crisis here and you need to protect. How do you protect from a system that's failing? Well, you take some money out. And if you invest all your money is exposed to it. I mean, they're more likely, I suspect, they being the fund managers, to end up when they come to the conclusion that perhaps it's a good idea to have exposure to gold, to put money in ETFs or other types of investments. But that's not a protection. You're still in the system. So, anyway, the big message here is this is just the end of the monetary system. That's all. No big deal. It's happened many times before. Many, many, many times before. This time, unfortunately, it's the whole world that's caught into it. But we'll get out of it. And the real wealth doesn't get destroyed. Okay? It just changes hands. And who's going to own it? Those who can buy it. Those who have gold. Thank you.